My name is Aman and I am a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I discuss how to transfer assets into your corporation on a tax-free basis. If you've been operating as a sole proprietorship business and think that it's time to incorporate, consider the Section 85 rollover if you want to save on taxes. Section 85 rollover is what allows your sole proprietorship, partnership, or corporation to transfer its assets into a corporation without having to pay taxes. Let's take an example. Let's say you are a general contractor who has not incorporated yet, as the existing sole proprietorship structure met your needs up until now, as you spent your entire net income on your lifestyle needs. Now, your business net earnings exceed your personal spending, so you actually want to incorporate as your business has grown. So the value of your assets such as building has gone up in value, and whenever you dispose or transfer these assets, you're going to have to pay a capital gain tax. In this situation, you can use Section 85 as it can help you defer the taxes into the future. You see, if you transfer your assets at cost, you can delay the tax implications into the future date. So there is a deferral mechanism in place. This recognizes the fact that you own the assets. The fair market value of the transferred eligible property must equal the fair market value of the consideration paid by your company. Let me explain with the help of an example. Let's say Mark owns a sole proprietorship with assets worth $100,000 now, and these assets were purchased for $40,000. Mark would like to incorporate the company now. Mark can take advantage of a Section 85 rollover by transferring his assets to the corporation to receive shares of the corporation and cash together, which are worth $100,000. Although as a transfer, you receive fair market value considerations for the property being transferred, tax deferrals can result because you and the company jointly choose an elected value at which to transfer eligible property. Section 85 allows to transfer a variety of assets. So it can be a stove, it can be a computer, it can be shares or investments, etc. This is one reason why I tell my clients laughingly, when in doubt, what type of reorganization to talk about? Talk about Section 85, because it will usually apply in most common scenarios. So under Section 85, the company or person transfers the asset into a new company at cost or fair market value, or any value in between these two. If they don't transfer these assets at cost, there might be immediate tax implication. But for example, if you have losses because your revenue has declined in the present scenario, maybe due to COVID, to cover or utilize those losses, you might want to trigger some gains. So if you want to cover the losses, you can trigger the gains by transferring the assets into a corporation at something between the cost and fair market value. So you can use the gain to cover the losses. You get to select the value. So normally you can transfer at the assets at cost plus the losses. As long as the value is less than the fair market value, you can do that. So remember that the ceiling is the fair market value and the floor is the cost. So you must choose a value between the two. So when I say cost, I mean if it is a depreciable asset, it will be the asset's undepreciated capital cost. You see, Section 85 should result in you owning the asset. Shares do not need to be the only compensation. So you can take back non-share consideration, which is also called boot, such as debt or cash as compensation. Generally, issuing as much non-share consideration as debt or cash as possible is advantageous because it allows you to draw money from the corporation more readily on a tax-free basis. Therefore, the main solution, the optimum solution, is to get non-share consideration equal to the assets transferred tax value. That is usually the elected amount, and then take shares with a nominal value. Please bear in mind that the non-share consideration, that is boot or cash, can not exceed the elected amount. You might ask whether you can choose a different elected value for different asset classes. Well, yes, you can do that. Let me explain with the help of an example. Let's say you have land and you transfer the land at cost into the company. Your land does not have any immediate tax consequences, but remember that land does not get depreciated, so it does not affect your income in the future as it is a non-depreciable asset. So if you want your balance sheet to look good and have some losses that you want to set off and you want to trigger the tax, you might want to transfer the land at a value higher than the cost. This will not affect your bottom line in the company because, again, land is a non-depreciable asset. On the other hand, if you, let's say, transfer a depreciable asset, let's say you are a caterer and want to transfer a stove at fair market value, it will start depreciating in the company at that higher fair market value year after year, which will impact your profitability. The reduced profits might not look good when you present the financials to the bank for a loan. Again, between cost and fair market value, the cost has no tax consequences, whereas the fair market value has tax consequences. So Section 85 is useful because it applies to various assets. It's useful because you get to pick the value on the T2057 form. It is useful because you defer the tax consequences into the future. One of the other benefits of Section 85 is that if you hold the shares long enough, you might qualify for the lifetime capital gains exemption, and that is really a good thing. Keep in mind that assets with accrued losses are not transferred under Section 85. And if such assets are really required in the corporation, they are sold to the corporation at their fair market value. The bad thing about Section 85 is that you have to take at least one share back. You also have to get a joint election. So if you have a partner and you are transferring it in and you have losses that you want to trigger, let's say your partner does not want to trigger the loss, you must agree on a value that gets transferred in. So if they don't want to trigger any loss and you want to trigger a loss, you might be out of luck, right? So to transfer it in, everyone who owns the piece of asset before must end up owning a piece of the asset after. And you must agree on what the elected value is. So you cannot say the value is 8,000 and then your partner Haley says, no, I picked 10,000. Well, CRA gets fussy about that stuff. Another disadvantage is that you cannot transfer real property such as land, which forms part of inventory under Section 85 in certain cases. So when you transfer real property like inventory, you have to do it at fair market value. For example, if you are a developer, the land which is real property is considered your inventory. And so in this case, you will need to transfer at fair market value, which means it does not transfer tax-free and you get a tax hit. Now, if you are a non-resident of Canada, you can still take advantage of Section 85. In other words, if you are not a resident of Canada for tax purposes, you can still use Section 85 in order to transfer assets to your corporation on a tax-free basis. As indicated at the start of this video, fair market value transferred must equal the fair market value received. So one critical step when using the Section 85 rollover is calculating the fair market value of your business. If you are running a medium to large scale business, then you may need to use a professional valuator. But if you have a very small business with simple operations, you may calculate the value based on net income for the previous years to establish its value. Think of how much you would sell the sole proprietorship to any third party. Keep in mind that your calculation should be backed by assets and income for each asset. The fair market value must be established. Let me give you an example. For a business that is producing 160,000 net income over the year, if we can use earning multiple of 3 to determine your business value, this might mean your business can be worth as much as $480,000. Please bear in mind that an earnings multiple is one way. The fair market value of the assets of your business can also be determined by the future cash flows. Your certified business valuator or chartered professional accountant can help you calculate your business's value and apply the tax rules for certain assets like goodwill and accounts receivable. As valuation requires a considerable amount of judgment, The legal agreement that governs the rollover of the assets to the corporation should include a price adjustment clause to give you the flexibility to adjust the consideration retroactively in the event a dispute occurs with the CRA. Whether it is a company restructuring for tax planning purposes or creditor proofing, or a successful sole proprietor looking to incorporate, Section 85 rollover is a valuable tax deferral tool if used correctly. You should not try to perform a Section 85 rollover yourself if your tax experience is limited. Please be sure to speak to a chartered professional accountant to help you understand your assets tax-free rollover. If you want to be notified about our new tax updates on tax planning tips and tricks, please consider subscribing to our YouTube channel. Thanks for watching and see you in my next video. Until then, bye.